What's up, everybody? In this video, I want to go over some of the most common questions I hear about the TSP or the thrift saving plan. For those of you who don't know, the thrift saving plan is pretty much the federal employee version of a 401k. You can do Roth, you can do traditional, and I think you can, don't quote me on this, but I'm pretty sure you can do about $20,500 a year. So it's a lot like a 401k. Um, Before we continue, this is not financial advice by any means. This is just mostly for entertainment and just me trying to explain some of the questions you might have regarding the TSP. This is not investment advice at all. So if you want to make a change to your current portfolio, if you want to make any decisions that could potentially be could affect your future, you should talk to a real financial advisor. And this video is just mostly for entertainment. So this is what you see right here is my TSP, my current TSP. I am a federal employee. For the sake of this video, I will look at it from a military perspective because I am in the military. So I've been in the military for a little while now, and I have this much money into my TSP. Currently, it's composed of almost 90% stocks and about 10% bonds. But I'm not currently allocating anything into bonds. It's mostly stocks. Once you're in this screen, when you log into TSP, you can go over here to where investments is. You click there. So when you first log into a TSP, this is what it looks like from the outside, right? When you first log in, you're gonna see this. This is your TSP account when you are on the web, not on the app. There's an app now for your phone that you can use, and they've been making pretty good progress when it comes to that. I remember when the TSP first rolled out, it was pretty outdated. It looked pretty clunky, and it felt like really old and not that good to the eye. But now they've been working on the website, and it looks a lot smoother. It looks a lot more clear nowadays than it used to. But anyways, when you first log in, this is what you see. This is pretty much a summary of your TSP, what you have, and stuff like that. If you go to investments, this is when you see you can see your pretty much a breakdown of some of the pretty much the ways for you to have your money invested, right? Let's start with this for starting from cash down first. I feel like if I explain these ones first, it would be easier to understand the life cycle funds, which are these ones on top. Anyway, so the G fund, right? You can a much better explanation than I could possibly give, and the explanation that I gave myself, I just log into my TSP and then open it, and pretty much an explanation what the G fund is. The G fund is pretty much government bonds. They're government bonds that they're supposed to be the lowest risk of them all, and also the lowest rate of return. So low risk, low return. Who should invest in this? Generally speaking, they consider people who have a short-term horizon, like you're about to retire or you're already retired. Generally, they say it's safer to be invested into this. According to these graphs that they offer here, they have this fund has for the most part outperformed inflation, and until recent years it seems that the rate of inflation is matching it. Whether it's accurate or not, I'm not sure. I'm just going off of what their website offers. I do have some money put into this, but these are pretty much government bonds. These are the safest thing you can invest your money in the TSP, and they will also have the lowest rate of return. Therefore, But yeah, by clicking on that, you will have a breakdown of pretty much all the information you need to have related to this fund. You'll see the expense ratio. Um, it will cost you this much per $1,000, about 60 cents per $1,000. That's pretty good. Pretty good. It's these are the rate of return for years since inception. It's pretty self-explanatory. You G fund, it's the most secure government bonds, and um, you can pretty much you can decide for yourself whether you want to have your money there or not. The next will be the F fund. These are also um, bonds, but they are a little bit different than the G fund because these are, according to this, I actually don't invest on this one at all, but according to the TSP website, it's managed by BlackRock. So this is what it's composed of, and it is managed by BlackRock. It says there are bonds as well. So I would say they're a little bit riskier than the G fund because, as you see, it has government related bonds, but it also has other types of bonds. So you'd have to be the judge of that. It's supposed to have a little bit better return than the G fund. Looking at this, and actually, it's not that much better. So yeah, you can look at this, the yearly return, 10-year return. I think the G fund was a little bit higher. But it's another types of fund, another types of bonds. And it's also privately managed by BlackRock, the investment company. Once you log into your TSP, you should look over this before you make investment decisions and take your time. This video is mostly to tell you that there's a way to actually look at this. Towards the end of the video, I'll mention how it should have happened. Sometimes I know when I first joined the service, I missed the letter that they were supposed to send me. So for a long time, I didn't know what I was invested on. I didn't know that I even had a TSP where I could allocate what to invest on. Anyways, this is the F fund. Next up, we have the C fund. In my personal opinion, this is just my opinion, and I'm not a financial advisor. This is the best place to be. This is actually where the majority of my money is, because I consider it to be the safest with the greatest rate of return. This is the C fund, and it pretty much invests in the S&P 500, which is the 500 best companies in the United States in our economy. Most of my money, I put it there. About 80% of my money goes into the C fund, and so far my rate of return is higher than pretty much every other fund out there. Well, almost. I guess this one is a little bit higher for now. But anyways, most of my money goes in there. And then after that, you have the S fund. This is also invested. These are also stocks, which obviously they would have greater risk than the bonds that we talked about before, but they usually also have much better return. The S fund, it's composed of small cap companies, usually also part of our economy. Usually these small cap companies, I think they are supposed to be greater than $1 billion. They're also supposed to be greater than $1 billion, but no larger than $4 to $5 billion, I think. Don't quote me on this. You have to read the whole thing yourself and actually. But they're not the biggest companies in the United States. They're not the best or biggest. They're usually up and coming companies that have the potential to be in the S&P 500 in the future and grow a lot, but they're still small and they're still growing. So it might be smart to have some exposure to this, because smaller companies with great future ahead of them do have great potential to outperform companies that are already established. As you can see, most of the TSP funds have around the same cost to own, and so I mean, I don't know if that would be a decision for you to make. Just so you know, like they are very volatile. You can see it here. The 1 year return is pretty low, actually very negative. By the 10 year out, it looks a lot better. So it's a decision you have to make with yourself and depending on your situation. Lastly, we have the I fund. This fund invests in international companies. Pretty much, you're investing outside of the United States. Personally, I have some exposure to this fund as well. I put about 5 to 10% of my monthly investment amount into the I fund and a little bit more into the S fund. The reason why is because sometimes the international economy does a little better than ours. So I think having a little bit of exposure to all of them, to these three, in my opinion, for me works the best. But the majority will be in the C fund. Now, lastly, we have the life cycle funds. All of these ones are pretty much based on your retirement date. So pretty much the higher the number, the further away from retirement you are. So the more risks they take. So they invest into this. So let's say, I'm not exactly sure the numbers, but let's say I would argue that 2065 has the majority, has very little from G fund and F fund, and a lot more from C, S, and I, just because they are stocks with greater rate of return. If you retire in 40 years, you don't have the need for the money anytime soon. So they have they just it makes sense to be a little bit riskier. Whereas if you're retiring in the next few years, or you are currently retired, which I think is with the if you are currently retired, it would be better to be on this area right here, because they would have a bigger exposure to bonds, which are much less volatile and will at least keep up with inflation, according to the graphs that we saw. Or actually, I don't think I've shown it to you. Let's see. According to their graphics, so this is pretty much this is pretty much the essence of it. You see, the higher number you are, the more stocks you have and less bonds. Whereas if you retire, or you are looking up to retire, you will be more exposed to stocks and less to bonds. And that's pretty much the essence of it. Um, we did see that earlier, that the G fund, that's the point that I was trying to get to, does outperform inflation. So if you are retiring, you just want to maintain wealth and you want to have money right then and there because you need it to survive. So it makes sense to invest more in these numbers, the lower numbers. And that, my friend, that's pretty much the essence of it. You just, based on this the TSP has actually gotten pretty good when it comes to the information that you can see. You just pretty much, you have to log into your TSP and just inform yourself and do your research and then make a decision. When you first join a service, like it happened to me, I don't know, I think I was investing into one of these, but at the time the C fund was doing so much better and I missed out on a lot. Also, when you first join, or if you had to opt in like I did, because I would join a few years before the TSP was an option. You will automatically have 1%. So I recommend that if you're in the service, because I match up to 5%, you do 5%. Now it's up to you and your personal circumstances, but it will make sense to invest 5%, up to 5%, because even if the market goes down, as long as it doesn't go lower than 5%, you will still making gain. You will still be making gains because the government is matching that 5%. So yeah, this is pretty much it. If you guys want to see more videos about how to change and allocate, and how to go from one fund to the other, how to change allocation numbers, comment down below and let me know, and I can make more videos. I want to start making more videos about financial stuff. I have a few videos coming up about another portfolio that I have for on a taxable account that I like to invest because I like investing. I like doing research on companies, and I think it's fun. And it'll be my pleasure to bring you guys along.